This would be our extreme high, and this would be our extreme low. This is on the 4 hour or on the 1 hour, but the 1 hour has to align with the 4 hour, not vice versa. The 4 hour has to be the main thing. You have to spot the range from the extreme low to the extreme high at the 4 hour. Later, we will explain, I will basically teach you how fractal trading can be. Basically, fractal meaning if we see something like this happen on the 4 hour and we've marked a range from the extreme low to the extreme high, it is easier for us to dive down from the 4 hour to the 1 hour to the 15 minute to the 5 minute to the 3 minute to the 1 minute because we know that this is aligning with a higher time frame. But if you start this on the 15-minute time frame, you're not going to be able to dive down that much because every candle takes 15 minutes instead of 4 hours. So being able to narrow down is basically a privilege that you would want to have because once you have the 15-minute aligning with the 4 hour, it's go time. So when price reaches an extreme high, it needs to rest. It needs to come back. It needs to fill the gaps. It needs to have efficiency. Now, what does that mean? It means that every time price comes to a new range, it comes back down for the simple reasons that I just explained. But before it comes down over here, we have huge imbalances marked on our charts here, 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 here. So when price comes all the way down, we are making price efficient, and this is what we label as efficient pricing. Before price has the retracement, this is called inefficient pricing. Now, price might need to retrace to here, then create a new range. It might need to retrace to here, then create a new range. It might need to do this, then create a new range. It might need to do this and then create a new range. We will never know for certain how much of a retracement price is going to have, which is why we need to make sure we focus on our key or extreme zones. If price doesn't come back to these zones, we don't want to be a part of the trade because the probability for the trade to happen more times than not is very little. The more depth we have in our retracement and the longer the duration of our depth of our retracement, the stronger the zone is. And that is simply because the more time means it aligns with the higher time frame, means the zone is stronger. So, how do these retracements start? What do we need to know from these retracements and why these ranges matter? When price comes to an extreme high, it will, by default start the retracement. That retracement we will call a pullback. When the pullback purpose is complete, that means efficient pricing is checked out, price comes all the way here, then goes and creates a new high. This is what we call the pullback over here. Once the pullback comes to our extreme zone or our key zone and then creates a new high, this PPC, meaning pullback purpose complete, once we have achieved that and that new high is achieved, the cycle is complete and we have entered a new range. We will go into details of how that pullback is happening. So, starting out, we have price coming to a new high and then starting this kind of bearish market in a bullish range. When price comes here, we know that the range is bullish. We know that price is creating higher highs and higher lows. In between this price, we have the 15-minute time frame. So this would be on the 4 hour, but this is what we would want on the 15-minute. So I'm going to take this out now just so you understand that this is the 15-minute because we're seeing the intricacies of what price is telling us within. Okay. Now, if you don't look at the 4 hour, what's going to happen to you is you're going to look at the 15-minute and you're going to see, oh, I'm just looking at price and I can see lower high, lower low, lower high, lower high, lower low, and lower high, lower low. As this is happening, if you can't zoom out and you can only look at this part and you haven't went to the 4 hour and determined your range over here, you would be basically trapped within the markets because when price is having the retracement, price could have the retracements like so, It could have more lower lows being created, and then somehow along the line, you can see a new high be created internally. That means internal price action. We have an internal break of structure over here. And that internal break of structure that has happened would trick you into thinking or assuming that price is bullish. So you start thinking that you spotted a reversal, but realistically, if you look at this over here and you draw your demand zone being somewhere over here, like we said yesterday, a demand zone would be a zone that has a higher low, goes on to create a higher high. Then out of nowhere, price does this and creates a new low in the market, then goes all the way to the extreme. We'll have this be like this, we'll have this be like this, just for the sake of it. Now, this over here would be nothing, and it wouldn't be a demand zone because you have zoomed out and you have noticed that your extreme low is your extreme demand zone in a bullish market. When price reaches somewhere over here, which is our zone, this is the only internal break of structure that you care about. After price has tapped into the extreme and now creates a break of structure, you will have something like this happen. That first break of structure happens. Then I'm going to introduce a new term, which is called the two-leg check. When you start seeing the two-leg check, it would mean your first internal break of structure moves from this point to this point. We care about this because we have tapped into the extreme and now we are moving with the trend and we want price to go all the way up. This is when it makes sense for us to buy, but this is the first leg, and then we have the second leg coming back here, and then we have a new break of structure. We want to buy from this point portion, and we would be looking to go all the way up. We have one leg, which is this one. We have another leg, which is this one over here. And when price taps into the extreme, inside this, we even go down deeper to the 5-minute. And on the 5-minute, you would see something like this happen. On the inside, you would see price coming down to the zone. You have a new internal happening. And then what happens here is we have something that is called imbalance. Now, if I want to draw it as candles, these imbalance structures would look like this. If our demand zone looks like that, that means we have a gap over here, which would be the imbalance that has been structured from this gap to this gap. That last candle that has created the break of the structure is our extreme refined zone. So this zone would look like this, but we would want to find an entry. And in order to find an entry, we need imbalance. If we have no imbalance, then we have no need for price to come over to this point. That means price is efficient and we cannot enter the trade. But basically, if we don't have imbalance, price would look like this. And this candle, we call it mitigation. And there's no imbalance over here. There's no space to draw. And our zone over here would not be valid because everything is mitigated above it. There's no need for price to come all the way down in order to go back up. So we would look for the next imbalance, and it could be somewhere over here. And this new imbalance is where we need price to revisit, and we would structure our stop loss under this, because if price goes under, we would want to leave as soon as possible because that means our zones are not being respected and price is reversing. This is what we would need to see on the inside in order to enter a trade. But forget about this for now. Well, actually, don't forget about this. Understand it. This is basically what we need from the push to happen. We would be buying from this portion over here. So basically, this is our huge extreme zone. But in order to enter the trade, we would want to see something, this box look like this, having our imbalance. And then we would enter the trade after the second leg. And one leg, two legs. So break of structure of the last point that created the low. This one. And then that is the first leg, and then second leg. This is where we want imbalance to happen. This is where we want to enter the trade. And then we want to target the higher high after we close our 1 to 3 stop loss under this. And our structure would be perfect. We would have our zone be over here, stop loss below the zone. We target the 1 to 3, which is here. And then our next take profit would be all the way to the extreme high over here.